What if I told you? Most traders don't lose because of bad strategy. They lose because they're trading the wrong time frame. They enter on the 5-minute chart, while the 4-hour chart is going in the opposite direction. They panic on small pullbacks because they never looked at the bigger picture. And that's why today we're breaking down time frame analysis, the correct way to align multiple time frames so you trade with the market, not against it. By the end of this video, you'll understand why higher time frames control lower time frames, how to combine daily, 4H and 1H properly, where to enter, where to avoid trading, and how professionals think about structure. Let's build this step by step. First, understand this. The market is fractal. That means patterns repeat on every time frame. A trend on the 1-hour chart looks the same as a trend on the daily chart, just compressed. But here's the critical difference. Higher time frames equals more participants equals more money equals stronger structure. A breakout on the 5-minute chart might be caused by small retail traders. A breakout on the daily chart? That's institutions moving serious capital. So when you ignore higher time frames, you are ignoring the players who actually move the market. This is where most traders go wrong. They zoom into small charts because they want fast entries. But professionals zoom out first, because direction comes from higher time frame. Entries come from lower time frame. Never reverse that. Think of time frames like a chain of command. Daily chart equals the boss. 4H chart equals the manager. 1H chart equals the worker. 5M chart equals the assistant. The assistant does not decide company direction. The boss does. If the daily chart is bullish, lower time frames pulling back are usually temporary. If the daily is bearish, lower time frame rallies are often traps. This is why countertrend trading is dangerous for beginners. You may win small, but when the higher time frame momentum hits, it hits hard. Professional rule: trade in the direction of the higher time frame bias. That one principle alone can eliminate 50% of bad trades. Always begin your analysis from the top. Example structure. If you are a swing trader, start with weekly, refine on daily, enter on 4H or 1H. If you are an intraday trader, start with daily, refine on 4H, enter on 15 meters or 5M. Let's say daily chart shows higher highs, higher lows, strong bullish structure. That means the market is in an uptrend. Now your job is simple. You are not looking to sell. You are looking for pullbacks to buy. That clarity removes emotional confusion. Now instead of asking, should I buy or sell? You ask, where is the next high probability pullback? That mindset shift is powerful. This is where structure matters. On the higher time frame, mark major support and resistance, supply and demand zones, break of structure levels, previous highs and lows. These zones are where institutions react. Lower time frames will simply create noise inside these areas. If price is sitting in the middle of nowhere, probability is low. But if price pulls back into a daily demand zone, now the game changes. Now you drop to lower time frame because you want confirmation. Higher time frame gives location. Lower time frame gives timing. This is where beginners usually mess up. They enter directly on higher time frame level without waiting for confirmation. Instead, once price reaches your higher time frame zone, move to 1H or 15 meters chart. Now look for break of minor structure, shift in momentum, bullish engulfing pattern, liquidity sweep, volume spike. You're waiting for proof that buyers are stepping in. This improves risk to reward massively. Instead of 100 pip stop loss, maybe now it's 25 pips. Same direction. Better entry. Smaller risk. That's professional execution. Let's walk through a full example. Step 1, daily chart. Market in strong uptrend. Recent pullback into previous resistance turns support. Bias equals bullish. Step 2, 4H chart. Price forming consolidation inside that support zone. No breakdown yet. Step 3, -1H chart. We see liquidity sweep below equal lows. Then strong bullish candle closing above minor structure. Entry triggered. Stop below recent low. Target equals previous daily high. This is alignment. 3 time frames telling the same story. When time frames align, probability increases. When they conflict, stay out. Sometimes the best trade is no trade. Now let's talk about confusion. What if daily equals bullish, 4H 等于 bearish, EH 等于 bearish. This is usually just a pullback inside higher time frame trend. So ask, is 4H bearish structure strong enough to break daily trend? If no, wait for pullback to finish. If yes, higher time frame may be shifting. This is why patience matters. Lower time frame noise should never shake your higher time frame, BIS, unless structure breaks. This is emotional discipline, not just technical skill. Starting from lower time frame, ignoring higher time frame zones, overanalyzing too many time frames, changing bias every candle, trading inside random areas. Clarity comes from simplicity. You don't need 8 time frames. You need 3 maximum. And you need consistency. Timeframe analysis reduces overtrading, FOMO, emotional entries, revenge trading, because now you have a framework. Instead of reacting to every candle, you wait for alignment. That builds confidence. And confidence builds consistency. Most traders lose not because they lack strategy, but because they lack structure. Timeframe analysis gives you structure. The market moves in layers. If you only see one layer, you will always feel confused. Zoom out first. Define bias. Mark zones. Drop down for confirmation. Align time frames. And trade with the bigger picture. Master this, and your trading will become calmer, cleaner, and more calculated. If you found value in this breakdown, start applying top-down analysis on every chart from today. Because professionals don't guess direction.